Welcome to our channel, where we dissect trading techniques, strategies, and theories to make you a more skillful and proficient trader. What are technical indicators? Technical indicators are essential tools used by traders and analysts to assess and interpret price and volume data in financial markets. They are mathematical calculations based on historical price, volume, or open interest data. These indicators can generate visual representations, typically plotted on price charts, to provide traders with valuable insights into market trends, momentum, volatility, and potential reversals. 4. Common types of technical indicators. Technical indicators can be generally categorized into several types, each serving a specific purpose. Number 1. Trend-following indicators. Trend-following indicators are instrumental in helping traders identify and confirm the direction of a trend. Notable examples in this category include the simple moving average, which calculate the average price over a specific period, and the exponential moving average, which gives more weight to recent data. Additionally, there's the moving average convergence-divergence, which detects changes in the strength, direction, momentum, and duration of a trend. The parabolic stop and reverse and the average directional index also fall under this category, providing valuable insights into trend direction and strength. Number 2. Oscillators. Oscillators are indicators essential for identifying potential reversal points and assessing the relative strength of an asset's price movements. Among these, the Relative Strength Index quantifies the speed and change of price movements. The Commodity Channel Index measures the relationship between an asset's price and its statistical average. Additionally, the rate of change assists traders in gauging momentum by measuring the percentage change in price movements over a specified period. Stochastic Momentum Index, another common oscillator, provides valuable insights into the strength of a current trend and potential reversal points. Number 3. Volatility indicators. Volatility indicators are used to measure and assess the level of price volatility, or the degree of price fluctuations. The Bollinger Bands provide a dynamic range within which an asset's price typically moves, helping traders identify periods of high or low volatility. The Average True Range quantifies the average range between an asset's high and low prices over a specified period, offering insights into potential price volatility. Number 4. Volume-based indicators. Lastly, volume-based indicators focus on trading volume and its impact on price movements. The On-Balance Volume Indicator helps traders gauge buying and selling pressure by accumulating volume on up days and subtracting it on down days. The Chaikin Money Flow measures the flow of money in and out of a security, providing insights into its accumulation or distribution. Additionally, the Volume Profile, also known as a volume histogram, displays the distribution of trading volume at different price levels within a specific time frame, offering insights into the strength of price movements. Although the world of technical indicators is vast and diverse, it's important to recognize that no single magic indicator significantly outperforms all others. In practice, as you apply indicators of the same category in real daily trading, you may find that most of them yield similar results, even though they use different measurement methods. Therefore, you don't need to invest your time in learning every indicator available. Instead, in this tutorial, we'll focus on demystifying the complexities by diving into the most common and widely used indicators that have demonstrated their reliability and effectiveness over time. Our objective in this video is to furnish you with a solid foundation in these key indicators, equipping you with the knowledge and skills necessary to make better trading decisions. Now, let's look into 5 most common and highly useful technical indicators. Number 1. Moving average. A moving average is a statistical calculation widely used in technical analysis to analyze and visualize trends in financial markets. At its core, a moving average smoothens out price data by calculating the average of a set number of data points over a specified period. This calculated average is then plotted on a chart to create a line that represents the average price over time. Besides, moving averages can play a dual role in trading. They can smooth out price fluctuations, making it easier to discern trends and its direction from the chaotic ups and downs of the market, and also serve as dynamic support when positioned below the price and dynamic resistance when placed above. For example, imagine a Bitcoin price chart where a simple moving average has been applied. When the moving average slopes upward and the price consistently remains above it, it may indicate a bullish trend. Conversely, when the moving average slopes downward and the price consistently remains below it, it may indicate a bearish trend. In this scenario, the moving average serves as a visual guide, smoothing out the price fluctuations and making it easier to identify the prevailing trend direction. Moreover, during a strong bullish trend expected to continue, the simple moving average can act as a support level when the price experiences a temporary pullback. You can often notice that the price tends to find substantial buying interest near or just above the SMA during these pullbacks. This phenomenon occurs because the SMA represents the average price over a specific time period, providing a reference point for traders. It signifies a level at which investors believe the asset's value is attractive, leading them to buy in and support the price. Conversely, during a strong bearish trend, it can act as a resistance level when the price attempts to rebound. Traders often observe that the price encounters selling pressure near or just below the SMA during these rebound attempts. This occurs because the SMA still represents the average price over the same time period, signifying a level at which investors consider the asset overvalued and are willing to sell. Furthermore, as we discussed in a previous video, it's important to remember that support and resistance levels, including those formed by moving averages, can switch their roles over time. This role reversal typically occurs following a significant price breakthrough. For instance, when a moving average has been acting as a resistance level during a bearish trend, and the price eventually breaks above it and closes consistently higher, this moving average can transform into a support level. This change signifies a major shift in market dynamics. Previously, the moving average was a ceiling capping upward price movement, but once breached, it becomes a floor, offering support for the new bullish trend. Traders often interpret this crossover as a signal of a potential trend reversal, marking the onset of a new bullish phase. Conversely, if a moving average has been functioning as a support in a bullish trend, and the price breaks below it and starts closing consistently lower, the moving average then transforms into a resistance level. What was once a supportive floor preventing the price from falling further now becomes a ceiling resisting upward price movements. This scenario often indicates the beginning of a new bearish trend, as the market sentiment shifts from optimism to pessimism, with sellers taking control and pushing the price downward. Limitation. Although moving averages are easy to use and helpful, it's essential to understand the limitations behind them. Firstly, they might not be suitable for all markets. While they excel in identifying trends, they tend to struggle in sideways markets, frequently generating false reversal signals. Secondly, moving averages are inherently backward-looking, relying on historical data to generate signals. This characteristic means they may not account for sudden market-changing events or rapid price shifts that occur in real time. 3 types of moving averages. The simple moving average is a fundamental type of moving average widely used in technical analysis. To calculate an SMA, you add up the closing prices of the selected period and then divide by the number of data points in that period. This results in a smoothed curve that helps filter out short-term price fluctuations, making it easier to identify the overall trend. However, SMA are less sensitive to recent price changes due to the equal weight assigned to each data point, making them relatively suitable for longer-term trend analysis. The exponential moving average. The exponential moving average is another common moving average type. Unlike the SMA, the EMA gives more weight to recent prices, making it more responsive to recent price changes. To calculate an EMA, you need to start with a simple moving average, and then a weighting multiplier should be applied to give more significance to the most recent data points. This results in a moving average that reacts more quickly to market developments, making it suitable for relatively shorter-term analysis and for identifying potential trend reversals. Traders often prefer EMAs when they need a dynamic representation of price data due to their higher sensitivity to recent prices, especially in fast-moving markets. The adaptive moving average. The adaptive moving average is a sophisticated type of moving averages, designed to adjust more effectively to changing market conditions. Unlike traditional moving averages, adaptive versions modify their sensitivity based on market volatility, offering a more dynamic approach to tracking price trends. Among these, the most famous variant is the Kaufman Adaptive Moving Average, developed by Perry Kaufman. KAMA stands out for its ability to dynamically alter its smoothing constant by calculating the efficiency ratio, which assesses the directional movement of prices relative to their volatility. This feature allows KAMA to respond quickly in trending markets while remaining stable during periods of sideways movement. By doing so, KAMA can enhance the ability to identify market trends and potential entry or exit points with greater precision than standard moving averages. Number 2, the moving average convergence divergence. The moving average convergence divergence, commonly known as MACD, is a widely used trend-following momentum indicator designed to help traders identify the strength, direction, and potential changes in a market's trend. The moving average part indicates that it's based on the average price of an asset over a specific period. The convergence aspect highlights the merging or convergence of 2 moving averages, while divergence suggests the moving apart or divergence of these averages. The MACD indicator consists of two primary components, the MACD line and signal line. The MACD line is the faster moving line, derived from subtracting the values of two EMAs with different period parameters. For example, you might use a 26-period and a 12-period EMA. This calculation results in a single line that oscillates above and below the zero line. The MACD line is responsive to short-term price changes and is often considered the more sensitive of the two lines. The signal line, also known as the trigger line, is derived from an EMA of the MACD line. For example, you can use a 9-period EMA. This line smoothens out the MACD line and makes it less volatile. When the signal line crosses above the MACD line, it generates a bullish signal. This suggests that the short-term trend is potentially turning more positive, and traders may consider entering long positions. Conversely, when the signal line crosses below the MACD line, it generates a bearish signal. This indicates that the short-term trend is potentially turning more negative, and traders may consider exiting long positions or even opening short positions. To have a better visual representation to assist in identifying potential changes in trend momentum, the MACD histogram, an integral part of the MACD indicator, is used for highlighting the difference between the MACD line and the signal line. The calculation of the MACD histogram is relatively straightforward. It involves subtracting the value of the signal line from the MACD line. It appears as a series of vertical bars or columns on a chart, with each bar representing the numerical gap between the MACD line and the signal line at a specific point in time. When the MACD line crosses above the signal line, the histogram bars are positive, which is displayed above the zero line and commonly represented in green, indicating increasing bullish momentum. If this crossover occurs when both lines are above the zero line, it may be seen as a potential trading opportunity, suggesting a potential uptrend continuation. Conversely, when the MACD line crosses below the signal line, the histogram bars are negative, displayed below the zero line and commonly represented in red, signaling increasing bearish momentum. If this crossover occurs when both lines are below the zero line, it may be seen as a potential trading opportunity, suggesting a potential downtrend continuation. Limitation. While the MACD indicator is a valuable tool, it's essential to be aware of its limitations and considerations when you use it. The effectiveness of the MACD can vary depending on market conditions. Just like the moving average we just discussed, while it can work well in trending markets, it may produce less reliable signals in sideways markets. During periods of low volatility, the MACD may generate multiple crossovers, making it challenging to identify meaningful trading opportunities. You should consider the overall market environment and adapt your strategies accordingly. Number 3, the Relative Strength Index. The Relative Strength Index, or RSI, is a widely used momentum oscillator that helps traders gauge the strength and potential direction of a market. At its core, RSI measures the relative strength of an asset by comparing the magnitude and speed of its recent price changes. By doing this, it creates a numerical value that oscillates between 0 and 100, offering a clear picture of a market's current state. In simpler terms, the RSI provides insights into whether a particular asset is overbought or oversold, which can be crucial for determining if an asset's price has reached extreme levels, signifying a reversal in the current trend. The Relative Strength Index is calculated by comparing the average gains and losses over a specific period, typically 14 periods. It involves summing the price increases and price decreases separately, and then calculating the relative strength by dividing the average gain by the average loss. To make the RSI less sensitive to short-term fluctuations and produce a smoother oscillator, a smoothing step is applied using an exponential or simple moving average. Finally, we can have the RSI value using its formula. RSI equals 100 minus the quantity obtained by dividing 100 by the sum of 1 and the smoothed RS. The concept of overbought and oversold conditions plays a pivotal role in understanding the RSI. When the RSI climbs above the 70 mark, it serves as a warning signal to traders. This threshold suggests that the asset in question may be overbought, signifying that its price has reached an exceedingly high level compared to recent price action. This scenario often raises concerns among traders about the sustainability of the ongoing upward trend. When the RSI breaches this level, it can be seen as a potential indication of overvaluation, and traders might consider this a prime opportunity to take profits or even initiate short positions. In essence, an RSI above 70 could be interpreted as a cautionary sign, potentially signaling an impending reversal or correction in the current uptrend, thus making it a candidate for a sell signal. On the contrary, when the RSI drops below the 30 threshold, it hints at a different scenario, This suggests that the asset may be oversold, indicating that its price has fallen to an exceptionally low level relative to recent price action. In such cases, traders start to look for signs of a potential reversal or bounce in the ongoing downward trend. An RSI below 30 can be seen as a signal that the asset might have been sold off too aggressively, potentially creating an opportunity for buyers to step in. This could result in a reversal of the current downtrend, making it a candidate for a buy signal. It's important to note that not all RSI values fall into the extreme overbought or oversold categories. RSI values within the 30 to 70 range typically indicate a more neutral market condition. This suggests that there is no extreme buying or selling pressure at play, and the asset's price is relatively stable. Traders often view this range as a period of consolidation or indecision in the market, where the asset's price may move within a narrower range. Furthermore, it's worth noting that these threshold values are not set in stone. Depending on the historical behavior of a specific asset, traders have the flexibility to adjust these levels to better suit the unique characteristics of that particular asset. In highly volatile markets like the cryptocurrency market, you may consider using a higher threshold, such as 80 or even 90 for overbought conditions, and a lower threshold, such as 20 or even 10 for oversold conditions. The RSI also exhibits limitations that traders must consider. It's not universally applicable to all assets. Its effectiveness can vary significantly. RSI tends to perform better in liquid markets with ample trading activity and well-established historical data. However, in markets characterized by low liquidity or when applied to assets with limited historical data, RSI's reliability may diminish. Additionally, in strongly trending markets, RSI can sometimes remain in an overbought or oversold area for an extended duration. This can not only create a situation where traders exit profitable positions prematurely, but also lead to misleading opening positions. Number 4, Average True Range. Average True Range, or ATR, serves as a quantifiable measure of market volatility. This indicator calculates the average price range between the highest and lowest points for a given asset over a specified time period. By revealing the historical price volatility of an asset, ATR can enable traders to make assessments of potential risks or rewards associated with their trades. Higher ATR values indicate higher volatility, meaning the asset experiences larger price swings during the specified period. Conversely, lower ATR values suggest that the asset's price movements have been relatively stable and less erratic. For example, if the ATR value for a Bitcoin is 300 on a daily chart, it implies that on average the Bitcoin price has fluctuated by $300 per day. One of the most practical applications of ATR is in setting stop-loss levels, a vital component of risk management in trading. ATR helps traders tailor their stop-loss orders to the specific volatility of the asset they're trading. When ATR values are high, it's an indicator that the asset is experiencing substantial price swings. In such cases, traders may opt for wider stop-loss levels, providing room for price fluctuations without getting stopped out prematurely. Moreover, ATR isn't limited to stop-loss placement alone. It can also serve as a valuable tool for estimating suitable profit-taking levels, especially in short-term trades. By gauging an asset's typical price fluctuations, traders can make more informed decisions on where to secure profits, ensuring that they capitalize on favorable price movements while mitigating the risk of potential reversals. But we won't delve into the detailed methods and steps for setting stop-loss and profit-taking levels in this video, as these intricate strategies will be thoroughly covered in our advanced tutorial series. Number 5, Volume Profile. But before we get into Volume Profile, let's first go through the basic concept of volume quickly. Volume in trading refers to the number of shares, contracts, or units of an asset traded in a specific period. In simpler terms, it tells us how active the market is for a particular asset. High volume suggests strong interest and participation, while low volume indicates less activity and potentially less interest in that asset. Now back to volume profile. It is a graphical representation of the trading activity over a specific period. It's displayed as a histogram on the right side of your price chart. To put it simply, imagine a price chart where the horizontal rows represent the trading volume at different price levels. This visualization allows you to see where the market has been most active in terms of trading volume. In essence, volume profile answers the question, where did most of the trading activities occur within a given time frame? Volume profile is calculated and constructed using data from lower time frames. In essence, when you're analyzing a chart of a specific asset on a higher time frame, such as a daily chart, the volume data used to create the volume profile is derived from lower time frames like the 1-minute or 5-minute charts. The choice of the specific lower time frame depends on the capabilities of the technical analysis tool you are using. This approach allows traders to see how trading volume is distributed across various price levels, even on higher time frames. The lower the time frame data you use, the more accurate and detailed the volume profile becomes, offering a more precise view of market dynamics. Volume profile is often used by traders to identify support and resistance levels. Peaks within the volume profile, which is also known as high volume nodes or HVNs, represent areas where the market spent a significant amount of time trading. These areas are considered points of high interest or fair value because they indicate that both buyers and sellers were actively participating. Therefore, they may act as potential support and resistance levels. Moreover, among the high volume nodes, the one with the highest trading volume is called point of control or POC. It's often seen as the fairest price during the specified period because it represents the area where most participants agree on value. Delta volume. Besides presenting the total volume on the volume profile, delta volume can be another choice offering a different perspective. Delta volume is another key concept that adds a unique dimension to volume profile analysis. It represents the net difference between up volume and down volume, quantifying the directional bias of trading activity at a specific price level. Up volume represents the total trading volume of trades where the closing price was higher than the previous trading period. In other words, it quantifies buying interest and upward price momentum during a specified time frame. Conversely, down volume represents the total trading volume of trades where the closing price was lower than the previous trading period. It quantifies selling interest and downward price momentum within the same time frame. A positive delta indicates a greater volume of buying activity compared to selling activity, suggesting a bullish sentiment prevailing at that price level. Conversely, a negative delta reflects a higher volume of selling activity compared to buying activity, signaling bearish sentiment in the market. Delta can be very useful as it offers insights into the balance or imbalance between buyers and sellers, helping us assess the strength of price moves within the volume profile. Delta reversal. Delta reversals occur when there is a noticeable shift in the delta value from strongly positive to strongly negative, or vice versa. This shift suggests a significant change in the balance between buying and selling activity in the market, which is often seen as a potential signal for a trend reversal. Observing delta reversals is crucial for traders, as these shifts can signal potential turning points in the market's direction. Consequently, they are frequently considered as opportune moments for initiating or exiting contrarian trades. For example, if the market has been strongly bullish with a consistently positive delta, and a delta reversal suddenly occurs, shifting towards a strongly negative delta, you may consider taking a short position or closing your long positions due to the consideration of a potential trend reversal to the downside. Conversely, in a bearish market with a negative delta, if there's a sudden delta reversal indicating a shift towards a strongly positive delta, you might consider taking a long position or closing your short positions, expecting a potential trend reversal to the upside. Volume profile, while a powerful tool in trading analysis, comes with its limitations. First, it can be resource-intensive, especially when using advanced software or platforms to create and analyze volume profile charts. This resource demand may pose challenges for traders with limited computational resources or slower internet connections. Second, volume profile is more complex than other indicators. Understanding how to interpret it and effectively apply it to trading strategies requires time and practice. Lastly, the accuracy of volume profile analysis heavily depends on the quality and reliability of the data source. Inaccurate or incomplete data can lead to flawed analysis and potentially misleading conclusions. You should be mindful of these limitations and take them into account when incorporating volume profile into your trading decision. Now let's look at a fundamental technique when using technical indicators: divergence. Divergence is a fundamental concept that appears in a wide range of disciplines, including mathematics, physics, economics, and trading. At its core, divergence refers to the concept of how values or elements within a system move away from a central reference point or baseline. It quantifies the degree to which individual components deviate from a common starting point. It plays a crucial role in understanding the behavior of various systems and phenomena across these diverse fields. In technical analysis and trading, divergence refers to the phenomenon that occurs when the price of an asset and a technical indicator move in opposite directions. It is used to identify potential shifts in market momentum and trend reversals, helping traders with decision-making. There are two main types of divergence: bullish and bearish. Bullish divergence occurs when the price of an asset forms lower lows, but the corresponding indicator forms higher lows. This suggests that while the price is showing weakness and making new lows, momentum is actually increasing. It can be an early sign that a downtrend is losing steam, and a bullish reversal or a strong upward correction may be imminent. Bullish divergence. For example, imagine the Bitcoin price makes a lower low by setting a new bottom, but during the same period, the RSI indicator forms higher lows. This discrepancy suggests that even though the price is declining, the downside momentum is waning, and a bullish reversal may be on the horizon. One more example. Imagine the Bitcoin price is consistently making lower lows indicating a downtrend, but the volume delta of volume profile is becoming more positive. You may interpret this as a bullish signal, indicating that despite the price decline, buying interest and pressure from buyers is growing, possibly leading to a trend reversal or bounce. Conversely, bearish divergence occurs when the price of an asset forms higher highs, but the corresponding indicator forms lower highs. This indicates that while the price is rising, the momentum is decreasing, potentially signaling an impending bearish reversal or a significant pullback. For example, imagine the Bitcoin price makes a higher high by reaching a new peak, but during the same period, the MACD histogram forms lower highs. This disparity suggests that, despite the price's upward movement, the bullish momentum is fading, and a bearish correction may be forthcoming. One more example. Imagine the Bitcoin price is consistently making higher highs indicating an uptrend while the ATR is decreasing indicating declining volatility and momentum, which is suggesting a potential bearish divergence. This signals that the uptrend might be weakening, and a reversal could be on the horizon. Now, let's move on to how to set the parameters for the indicators. Parameters are the variables that define how an indicator calculates and displays its output, which involve making changes to settings such as time periods, moving averages, or standard deviations. The adjustment of parameters plays a pivotal role in influencing the sensitivity and responsiveness of technical indicators. In essence, these parameters act as tuning knobs, allowing traders to fine-tune the behavior of an indicator to align it with their specific trading strategies and preferences. When you alter parameters, you are essentially modifying how the indicator interprets and reacts to price data. For example, most indicators involve the time period or look-back period parameter, which determine how much data points should be calculated. Using a larger parameter widens the dataset used for calculations. It tends to induce a smoothing effect on the indicator's output, diminishing its susceptibility to short-term market fluctuations or noise, making the result less sensitive. In essence, it acts as a filter, accentuating more prominent trends while tempering momentary price swings. Conversely, adopting smaller values narrows the data window, focusing on recent price movements. This adjustment heightens the indicator's responsiveness, enabling it to capture and react to short-term trends and market shifts with increased agility. This heightened responsiveness becomes particularly valuable to you if you aim to make swift decisions in rapidly changing markets. For example, consider a swing trader who is analyzing Bitcoin's price movements over the past year on a daily chart. If a larger time period parameter is chosen, such as 200 days, for the moving average indicator, a smoothed, long-term perspective on Bitcoin's trend will be provided. This means that even if there are short-term fluctuations or noise in Bitcoin's daily price movements, the 200-day moving average will reflect the overall trend more steadily. On the other hand, if the same trader opts for a smaller time period, like 20 days, the moving average will react more swiftly to recent price changes. This can be advantageous when the trader is looking to capture shorter-term swings in Bitcoin's price. So, the choice of the time period parameter depends on the trader's specific goals and the time horizon of their trading strategy. It's important to emphasize that there is no one-size-fits-all parameter setting that guarantees success in trading. Traders often seek the elusive magic parameter that will lead to consistently profitable outcomes. However, the reality is that the effectiveness of indicator parameters depends on various factors, including market conditions, asset volatility, and individual trading goals. What works exceptionally well for one trader might not yield the same results for another. Therefore, it's crucial for you to engage in systematic experimentation, rigorous backtesting, and meticulous analysis of parameter adjustments within the context of your technical analysis and trading strategies. For beginners, we recommend starting with the default parameters. Like all technical tools, divergence is not foolproof. Remember, there is no holy grail indicator that delivers flawless entry and exit signals. In fact, even the most reputable indicators don't consistently provide accuracy rates above 60%. While technical indicators are valuable tools for assessing market conditions, especially for potential trend reversals, they should never serve as the sole guideline for your trading decisions. Instead, think of them as reference points in your trading arsenal. Successful trading involves a holistic approach, where you consider a range of factors, including market fundamentals, sentiment, and technical analysis. Relying solely on indicators can lead to disappointment and losses. It should be used in conjunction with other forms of analysis and confirmed by additional technical indicators and price patterns. Thank you for watching this video. Feel free to drop any questions in our Telegram group, and we will do our best to provide answers. Engaging with fellow traders can also provide valuable insights and different perspectives. As always, trade smart, and we'll see you in the next video.